Friends, in this video for I Thought Wealth, I am going to talk to you on the topic multibaggers versus compounders. Many of you may wonder about whether these are actually different. Let me explain. If you want to compound your money over 10, 20 years, then you need a particular type of approach where businesses keep growing consistently over that period and they have more predictability. When a business has more predictability over a very long period of time, they tend to be compounders first. That is their basic criteria for growth and that is their basic strength. When they have that strength, then becoming a multi-bagger is an incidental outcome. So businesses which are intrinsically strong, which have very strong moats, competitive position in the industry, very strong visibility of growth and very good managements tend to be compounders first and multi-baggers by incidents. As an investor, if you ask me what worked the best for me, it is investing in these kind of companies, because over 10, 12 years, sometimes these companies can go up even 10, 20 times, because if you buy them cheap, then they compound their business and become massive multi-baggers. So ideally, if you are able to find companies like that, I would always prefer that to companies which in short bursts of time have a change in their business situation, which throw out what I call as carnival profits. Profits which are eye-popping but never last. A good example is the graphite industry or commodities like sugar or maybe even businesses where short cycles happen. I would put pharma intermediates also in that category. Yes, they are multi-baggers. They are businesses which see a dramatic change in business fortunes over short bursts of time. But do they really have the capacity to become compounders? In my view, most businesses of such nature do not have that capacity. As an investor, if one is lucky to get them early, or if you even got reasonably good time to make a lot of money, there is a tendency for you to believe that this multi-bagger is a compounder. That in my mind, to my mind, is not a correct belief, and that's a belief that needs to be rechecked, because these companies have seen a near-term change in fundamental that is so dramatic, but are not going to sustain. Now, when the change is so dramatic and at a peak where it's eye-popping, it's very difficult to question whether it will sustain. Even if I ask that question, like a swarm of bees, people will come and fight that opinion. So most people take the convenient option of concluding that these are compounders. There is another thing that misleads you into believing that these are compounders. These companies, when the tide turns and they are starting to do well, will be at a valuation of 1 or 2,000 crores. Very quickly, they go to 5, 6, 7,000 crores because of concentrated ownership and many other tricks of the trade. When that happens, mutual funds get in, institutional investors get in, and there are already very solid hands holding these companies. So no one lets go of them as long as the tide is running. So no one wants to get off, and a lot of people are forced to get in. So that again creates a mythical impression, a mirage to the eyes of the investor that these are actually very strong companies and they will be compounders, and I don't see how the trend will break. But the trend eventually always breaks in these kind of companies. So you must know your multi-baggers and differentiate them from the compounders. You need to get out of them and you need to go to safety. In my experience, I have done this several times in the commodities, and that's why I am very scared to even mention the name of companies, because somebody may mistake these companies at the peak of their multi-bagging moment as compounders and then hold them and then make a loss and then find fault with me for naming them. That's something which I have always avoided, and I think we should avoid such things. But you should understand the difference between multi-baggers and compounders. As an investor, I have done both things, but it's very important that I put them in separate silos and not mix them up. And I think most people in the market tend to mix them up because the success of the multi-bagger is so strong in such a short burst of time, and people are so excited about that success that they make even the doubting Thomas believe that this is going to be forever. Now, how an investor is going to work in separate silos in multi-baggers and compounders is your choice, but I am more comfortable working in the compounder silo than in the multi-bagger silo, because eventually nobody walks away from seeking such opportunities in the multi-bagger silo, and sometimes they topple and fall. It's happened to me before, and I wouldn't want it to happen to my investors. So I'm very, very careful about that aspect. So I always prefer to play in the compounder silo, play the waiting game, and make that money over 5 to 6 years. So it's better that one takes a more consistent and a more calculated investment route than a route which is very tempestuous and hard to navigate. So in that sense, you should know the cut between multi-baggers and compounders and choose what suits you. Compounders will be multi-baggers, but not all multi-baggers can be compounders. Make the cut and enjoy your investing. Do share this video with your friends who love equity investing and are passionate about it. And do stay the course with me on this journey in I Thought Wealth. Thank you very much.